Hi, everyone, and welcome back to another episode of the Synergy Sessions. My name is Ana Caetano.
My name is Eliane, and today we have the absolutely two best in the business, Jahn Beckler and Damion Campbell, and they are with AMS Mortgage. So thank you guys for joining us today. We have a long list of questions, but first, I think we should kind of start with let everybody know a little bit about you guys and how you guys came about, and you guys are longtime partners.
Oh, I'm sorry. Okay. So my name is Damion Campbell from AMS Mortgage. We're located in Woodbridge, New Jersey. Jen and I have been partners for, probably the past 20 years doing mortgages. We started together over at a company that he owned 20 years ago. And then, we've just been working together ever since.
Yeah. What he said.
Okay, great. Let's jump into questions because we do have a lot for you guys today. You go, Anna.
Yeah, so I'm very excited to ask this question because it's something most people do not understand. What's the best description for you guys, and what's the difference between a regular bank, lender, and a broker? And why is it important to know the difference?
The difference between bank and broker is if you deal with a bank directly, you're dealing with their one set of rates, guidelines, and programs. When you're dealing with a mortgage broker, you're dealing with every program that exists in the United States of America. We basically have access to every single product under the sun because we work with about 215 different banks, so we represent all their products.
Yeah, and whenever we're working with clients, we always try to get them to work with a broker like yourselves because it's better for them to have full
only
access.
us as a broker.
Awesome.
All right. So, what is the biggest mistake a buyer can make before applying for the mortgage?
I think the biggest mistake a borrower can make is actually not getting pre-approved or pre-qualified before starting the process. What they should do is have their credit pull. We could do a soft inquiry just to see what the debts are, provide all their documentation, income, assets, just to make sure that they're prepared. Because majority of the times, these clients, they don't know what's on their credit report.
Okay, a lot of buyers ask the same question. Okay, are they going to pull my credit? Is it going to hurt? Am I going to lose any points?
So if we're doing a soft pull, no, it's not going to hurt. We're just doing a soft pull showing what the debts are and what your credit score is.
And going back to the hard pull doesn't hurt their credit either. It only hurts their credit is if we pull it, and then outside that 30-day window, they decide to start shopping around and have multiple people pull it. And if multiple people pull it, the difference between happens, inquiries will hurt the credit a little bit. It doesn't really kill it that much. But sometimes they'll say that our credit score went down drastically because you pulled my credit. No. The first time we pulled it, you had no balance on your Visa with a $5,000 limit. And the second time we pulled it was maxed out, $4,900. So the difference is whatever is on the credit report may be different the second time it got pulled. They don't take that into account.
Yeah, and I find myself having that conversation multiple times with buyers, especially we do first-time home buyer consultations all the time, and we find ourselves having that conversation, how is it going to affect my credit? Well, if you don't go shopping around, then within that first 30 days, you should be fine.
Right. Exactly.
So we spoke about things that they do wrong before the home shopping process, but let's talk about the things that they do to sabotage themselves during the whole process, such as
applying for new loans, getting a car payment of $1,000 a month when we pre-approve them without the car payment. That could hurt their buying power because you have your front end ratio of what's allowed and you have your back end ratio. So that can take them over the top.
So it messes with their debt to income ratio.
It absolutely can kill the debt to income ratio, or it could switch them from having to be a conventional buyer and is switching into FHA because the debt to income ratio goes over 50%, which is allowable, but then you're an FHA buyer.
Right. And then you're PMI, all that fun stuff.
Correct.
Awesome.
All right. So, what's more important, or it's interest rates or purchase price,
Purchase price.
Purchase price.
and why?
Because you could always refinance the house for a lower rate later on in life.
And to me, if you find a property that you like, you're in love with, and you're willing to pay that price for it, go with it because, like Jan said, you can always refinance.
And prices eventually always go up, so why wait?
Exactly. Right.
You could always refi. What do you think people? Do you think people who are waiting for the perfect rate are making a mistake?
Definitely making a mistake. Because,
Absolutely. There's no such thing as a perfect rate because, rates can go up, they can go down. So, like I said, if you find something that you like, you're okay with the payment, go for it.
Can't time the market.
Exactly.
You can try, but it's never really going to work out. So.
This is another very popular question. Is 20% down actually necessary? Do I need to save 20% down before I can start even thinking of purchasing a home?
Absolutely not.
Okay, so what are my
Conventional
options?
has a 3% down program. A lot of people are under the misconception that to go conventional and not go FHA, you have to have 20%. Conventional goes as low as 3% down. And if you own a house already and you want to buy a second house, your second house, even keeping that house, you can do 5% down for
And
conventional.
I'm glad you said that, because even at 3%, there's still a misconception where I hear a lot of people say the lowest is 3.5.
Yes,
is not
I
true.
hear
Three
that
and
all
a-
the time.
but they think that FHA is the way to go when conventional actually has a product with a lower down payment, which is 3%. FHA is 3.5, conventional is 3.
So let's talk about credit score then. Where do their credit score need to be in order to
Well, now
qualify?
there's really no FICO requirements. So, like, I was pricing out a loan conventional this morning, 580 FICO score, 5% down, 3% down, 580 FICO score conventional, which I was like shocked that the pricing was there, and they were getting a rate in the 6s.
Wow.
But you may have a problem getting the PMI with that low credit
Yeah,
score.
PMI is a whole separate fact, but you can actually get. They have something called loan level pricing adjustments, and if your income is at a certain, it's not over a certain dollar amount, and your credit score is a 500 credit score, and you're putting down, let's say, 20%. I've had it where a guy putting down 20% or even 10% with a 500 credit score, unconventional, was getting a lower rate than the guy putting down 20% with an 800 credit score.
So I always like to say, when in doubt, just ask, because so many times we get, well, my credit score is not that good. Well, you don't know what you'll
Yeah, they
actually
don't know.
qualify
They don't
for. So, awesome.
And okay, so we spoke a lot about PMI. I want you to explain to the audience in simple terms what PMI is and when does it, how long is it going to stay there forever? Why does somebody need to get a PMI and why not?
So, like for FHA loans, there's PMI for the life of the loan unless you're putting down 10%.
Okay.
PMI is roughly around 0.55% of the loan amount divided by 12. If you're putting down 5% or less. If you're putting down more than 5%, the PMI is 0.50. It also depends on the loan size. If the loan size is over, I think it's like
726,
like around 726, it's around 0.75 if you're putting down less than 5%, and then 0.70 if you're putting down 5% or more. Now, for conventional,
to recap on that, like when you put down 10% with FHA, it's not for the life of the loan, but it's for 11 years. PMI.
now with conventional loans, if you're putting down 20%, there's no PMI. Conventional is more credit score driven. So the higher the credit score, the less the PMI. But FHA, it's regardless of the credit score, it's the numbers that I just gave, 0.55 or 0.50.
And going back to conventional, if you put down 5% with conventional, the other 15%, once you pay it down, the PMI just falls off. Or if you wait 2 years and you know your house appreciated, where you only owe 80% of the value of the house, you can call the bank. They'll send out an appraiser. It's usually a drive-by appraisal. And if you're right about your value, the next month your PMI will be gone.
I know. I need to do that.
I was just going to say that. I
No,
gotta do
because
that on my
you
house.
told us that back in January, and I said I was going to do it, and I still haven't done it. I am sure.
It's just a phone call.
I'm sure we're.
It's a phone call and $150.
Because if you don't make the call, they continue charging you, right?
They're not
They'll,
gonna
well,
tell you
think
that.
about it.
they'll continue charging it
Until-
until they think that you're at 78%, then automatically it gets released.
Oh, okay. So hopefully
But
they already figured it
78%
out.
off of what you originally bought it for and what their 30-year amortization schedule looks like.
Got it.
Okay. All right.
Well, what is something, I'm actually very excited about this question. What's something that underwriters care about that most buyers don't think about?
Large deposits in their bank statements.
Yes.
Thank you, Aisha.
Thank you, Aisha.
Shout out to Aisha for helping us out there. But why is that? Is there any particular
Well,
reason?
if you have a deposit in your account for over 25% of what your monthly income is, they're going to want you to source and season where it
Explain
came
where it
from.
came from.
So if you can source and season where it came from, that's fine. But if it's cash and you need that money, they won't let you use it.
Right.
Got
You
it.
cannot use that money. We can have a bank statement with $100,000 in it, and if $25,000 is something you can't source in season, we look at the bank statement as $75,000. That 25, it's not even there.
Got it.
And what underwriters are really looking for is to just make sure that there's no undisclosed debt. So if you have a large deposit, they want to make sure that there's no debt attached to that large deposit because
Makes
that increases your debt to income ratio.
Got it. All right.
When does it make sense to buy points? And what is it, for somebody to come in and buy a point? So I want to just think about it. Like a lot of the people never even heard of that before. So just explain to the audience.
It
When does it make
It has
sense?
to
What
make,
is it?
like, if it's a primary residence, it has to make sense in what's called a break-even point.
Right.
So if you're paying, $7,000 or $10,000 or $20,000 for a point, and you're only saving $60 a month or $100 a month, you take whatever the points cost you, you divide it by the savings every month. If your break-even point is in 12 years, 10 years, it doesn't make any sense. But if your break-even point's in 3 years or 5 years, it could make sense to you. What that means is that if you're paying $14,000 for points and you're saving X amount of dollars, if you don't start saving that money, the break-even point, in 5 years and 6 months, you don't see that savings until 5 years and 7 months. You finally save that $100 or $200 or whatever it is. So you got to analyze the break-even point. If someone thinks they're going to sell the house in a 5-7 year period
Or refinance.
it doesn't
not
make
worth it.
sense because you're gonna get out of that mortgage anyway.
Got it. Yep. So that's something that I felt like we needed to bring up because people don't know that that's a thing, but they also, the people that do feel like they need to do it each and every
But
time. and
that's on a
necessarily
primary
the
residence.
truth.
For investment property, points sometimes do make sense because to get the lower rate, you got to pay points on an investment property to get a lower rate. Like otherwise, you take a higher rate, you could be 6.75%, 7%, and the bank is compensating us for that rate. But if you want a lower rate because your monthly income that you're getting in for the property isn't making sense, it's off balance, then you want to buy points to get the lower rate so it's monthly you're making money on the house.
Make it all work out. Got it. What about self-employed people? What's the biggest challenge with getting pre-approved?
Too many write-offs.
Yeah, too many write-offs. Too many write-offs.
Okay. How does that hurt them?
Because when we're analyzing the tax returns, all we're looking at is your net.
What you brought home.
Yes, what you
Net,
brought
net
home.
adjusted gross and depreciation
Right, because
combined.
you could have made $1 million, but if your write-offs are $999,000, your income is $10. You
Yeah.
can't really purchase anything with that amount.
So that leads me into my next question. So if for the people out there, they're looking to purchase a home, they're on a 1099, they kind of need to start preparing because, most people do write it off as much as possible, right? So if they're planning to buy a home 6 months to 12 months from now, the very first thing they need to do is like start doing their income tax properly.
Right.
All right.
All right. So are you guys ready for a little bit of a rapid fire here?
Let's go.
All right.
I know those are very good.
Are rates going up or down this year?
Down.
Best loan product out right now?
30-year fix.
DSCR.
Yes,
wow,
yes,
what a
yes.
difference.
DSCR.
We're
DSCR.
gonna have to talk about that in a little
Yeah,
bit. Okay.
DSCR.
Biggest mortgage myth? I have my answer, but I'll let you guys answer.
Biggest mortgage myth.
You have to put 20% down.
That
Yes,
was my
that was
answer.
my myth.
That-
Yeah.
yeah.
Well, we just covered that.
Or you need 700 plus credit score to purchase a property.
Yeah.
Gotcha. Buy now or wait.
By now.
Awesome.
All right. So hold on. Now that you mentioned, let's talk about DSCR loans for a little bit. I kind of feel like that we started hearing that terminology more now in the last 2 years than back in the day. So explain to people what type of loan that is, and when should somebody be exploring that option?
Okay. Gonna take it over. So the DSCR means it's a debt service coverage ratio loan. What we're looking at is the income. It's for investment properties only. We're looking at the income that the property is producing. So we're looking at, let's say it's a 2-family home. We're adding the rental income for both units, and as long as it's greater than the mortgage payment,
Or
we're good.
matches.
Or matches, yeah. That's 1-to-1, we're good. Sometimes we could go a little bit below 1-to-1, but
Yeah,
for the
you can-
best rates, 1-to-1 ratio.
Yeah, so if your mortgage payment is $5,000 a month, you want the rental income to be $5,000 or higher. If it's lower, we could do it too, but the rates are going to be higher.
Okay. All right. So primarily for investment properties.
Investment purposes only.
DSCR, anytime you hear that, that's for an investment property, always.
Okay. And if you could give one advice, just one for future home buyers, aside from doing their tax correctly, what would you say?
Give Jahn or Damion a call.
Oh, I love that.
It's a very good answer.
Yeah, that's the best advice.
I absolutely love that.
Well, I have one last question for you guys. What's your unpopular mortgage opinion that would make people argue in our comments?
Brokers are better than banks.
Brokers are better than banks.
1,000%. Brokers are better.
and the banks know it too. I got banks that call me all the time. Hey, can I use your username and password to see what the pricing looks like on the broker side? You know who you are.
And I have another one that banks can close loans faster than brokers.
That's a myth.
Absolutely not true.
That's a myth. Yeah.
Total. We've closed loans in 13. As long as whatever the rules and regulations are for disclosures, we've closed loans in 13 days, 14 days, easily. If you put it on the radar and you say you got to close in 13, 14 days, we'll close it.
Yes.
But you got to let us know.
Right.
We have, like, we did this in the office like last week. I don't know who it was. They were like, well, they say that the banks, they have direct access to the underwriter. I said, well, hold on. And I hit
Aisha?
speed dial on my phone, and I had the vice president of the bank pick up. I'm like, Ryan, if I need you for something, yeah, I got you. Okay, let me go. I said, I just want to show you how fast I got forget the underwriter. The underwriter's boss,
Right.
I got on the phone.
Got
Very
it. All right. Well, for people who want to find you guys that aren't necessarily reaching out to me and Eliane, what's the best way to reach you guys directly?
You could contact me on my cell phone, 770-891-2018, or DM me, Damion_mortgage guy.
Awesome.
And our office is in Woodbridge, New Jersey, but we're licensed in multiple states.
Jahn Beckler, please call Damion.
Okay. Well, thank you guys so much for jumping on the podcast with us. We appreciate everything that you do, not only for me and Anna and the team, but for many, many realtors out there. We truly do believe that we're partners more than anything. We do not look at you guys as vendors.
We're definitely partners.
And so thank you.
You guys
Thank
get
you.
it done
Thank you.
all the
No,
time,
thank
so
you for the business that we do together.